Hello, and welcome to Mission Wealth's Market Perspectives for the third quarter of 2019. My name is Kieran Osborne. I'm the Chief Investment Officer at Mission Wealth, and I'm pleased to be presenting to you today. This presentation will focus on a few key themes: an update on market performance, our thoughts on the Fed and the ongoing trade war, and the implications for the economy and interest rates moving forward. If you focused only on headlines year to date, you could be forgiven for thinking it was a very challenging start to the year, when in fact, the opposite is actually true. It has been an extraordinarily strong start to the year in 2019, with all major asset classes posting very strong returns. In fact, the S&P 500 has experienced its strongest first half of a year since 1997, while the broad bond market is on track for its best performance since 2011. We do expect some moderation in returns moving forward, given that strength. However, stocks are trading roughly in line with their historic valuation multiples, with US stocks marginally above their historic range, whereas the most attractive levels can be found in international and emerging markets. The Fed has pivoted its communication strategy from being relatively hawkish at the beginning of the year, anticipating one or maybe even two more rate cuts, to now all but saying that rate cuts will happen in the second half of 2019. In fact, the market is currently pricing in 4 25 basis point cuts over the next 12 months. A key reason for the Fed's change in tone has been the ongoing trade war with China. We do anticipate that this narrative is likely to continue for an extended period of time. The increased uncertainty has led to a slowdown in global growth and elevated levels of market volatility, and only serves to underpin the importance of well-constructed, diversified portfolios to help mitigate the ongoing volatility in markets. The current economic expansion will become the longest ever this July. We do expect growth to slow somewhat, but we do not see any signs of an imminent recession. Business fundamentals are still very sound. The labor market and the consumer is very strong, and we don't see anything in the way of inflationary pressures, and interest rates are likely to stay lower for longer moving forward. We believe these current dynamics may offer the opportunity for well-diversified fixed income portfolios to add enhanced return potential moving forward. As this chart depicts, the first half of 2019 was extraordinarily strong across all major asset classes. Despite negative headlines regarding the ongoing trade war negotiations and its impact on the US and global economies, the S&P 500 experienced its strongest first half of a year since 1997. At the same time, the broad bond market is on track for its best performance since 2011. Two major themes dominated markets year to date: the US-China ongoing trade negotiations, and secondly, Fed policy. Stocks were impacted as the US-China trade saga moved from a sense that a trade deal was imminent in April to an abrupt breakdown in negotiations in May, before a current ceasefire on further tariffs occurred towards the end of the second quarter. And we now have a commitment by both sides to continue discussions moving forward. Market sentiment was lifted in June as the Fed stepped in with much more dovish communication, all but saying that it will likely cut rates in the second half of the year, which really did help underpin stock market strength. Despite the strong bounce in stocks, the S&P 500 is still trading only marginally above its long-term average price to earnings multiple, as depicted in this chart here. At the same time, international and emerging markets trade slightly below their long-term averages, offering potential attractive opportunities there. And we do ultimately think some form of trade agreement will be reached with China. If and when that does take place, we anticipate that international and emerging market stocks are likely to benefit more than the US, given those countries' larger exposure to global trade. So moving forward, we do expect some moderation in equity returns, given the very strong first half of the year we've already experienced. Looking at consensus earnings expectations and current price to earnings multiples, the implied expected return on the S&P 500 over the next 12 months is around 6%, whereas for international stocks is a little higher at 10%. So expectations should be set for in that mid to high single digit range moving forward. The Fed has pivoted its communication from being relatively hawkish at the beginning of the year to much more dovish recently. After starting the year indicating they were likely to raise rates at least one more time, the Fed's stance turned more cautious and they adopted a wait-and-see approach before turning more dovish currently as the extent of the trade war saga became apparent. And inflation continues to remain stubbornly low and below the Fed's 2% target. The market now believes there will be 4 25 basis point rate cuts over the coming 12 months. We don't anticipate quite that extent, as the Fed is likely to want to leave some buffer should the economy slow further. But there does appear ongoing downside pressures on short-term rates moving forward. It's likely that the Fed will highlight the stubbornly low inflation rates as a justification for cutting rates. Inflation has continued to be at or below the Fed's target of 2%, and we don't anticipate it creeping upwards anytime soon, given that oil prices are range-bound, as depicted in the chart to the top left. Wage price inflation appears to be stabilizing, and we have a backdrop of slowing global growth, all of which is likely to contain inflationary pressures moving forward. Turning to the US-China ongoing trade war negotiations, if we backtrack a little bit and think about the timeline year to date, discussions appeared to be heading towards an agreement in April. At that point in time, the market and expectations were that it was really a question of when, not if, a deal would take place. Then negotiations abruptly broke down in early May after China sent back some changes to the proposed text on the agreement, which was seen as backtracking and reneging on their agreement, original agreement. President Trump then sent out a tweet notifying the market that increased tariffs will be imposed in the near term. Fast forward to June, and a quote-unquote ceasefire was reached on any additional tariffs as talks continue. Now, we anticipate the trade war narrative is unlikely to subside near term. While it is ultimately in the best interests of both sides to come to some form of agreement, we do not anticipate a resolution anytime soon. The Treasury, for instance, recently stated it was hopeful an agreement would be reached by the end of the year, We are not holding our breath on that timeline. Unfortunately, the ongoing trade war saga has led to an uptick in uncertainty and volatility. And that has in turn led to a slowdown in global growth. And the reason why that is it's just very difficult for businesses to undertake large-scale projects when there is uncertainty regarding the rules of global trade. In fact, talking to our business investment partners, there appears to be a lot of pent-up capital sitting on the sidelines, awaiting some form of clarity surrounding the ongoing trade war negotiations. But the opposite is also true, and that's important to keep in mind. If an agreement is ultimately reached, there may be an influx of business spending as all that capital sitting on the sidelines is eventually invested, which in turn may lead to another economic stimulus once the current uncertainty is removed. All of which really underscores the importance of well-constructed and diversified portfolios, which may help mitigate the ongoing market volatility. Turning to the economy, at the end of July, the current expansion will become the longest ever. So, do we anticipate a recession in the forthcoming period? No, is the short answer. We don't anticipate a near-term recession occurring for a number of reasons. One, business fundamentals are still sound, the labor market and the consumer is strong, and inflation is well contained, and we see that interest rates are likely to stay lower for longer moving forward. We do, however, expect a slowdown in growth rates in the third quarter and the fourth quarter of this year, particularly as the short-term benefits of tax reform wear off. Investment spending, in particular, has been hurt by the trade war uncertainty, as I spoke to earlier. But still, the underlying health of the economy is relatively robust, albeit slowing. And we knew this heading into this year, that the economy was likely to slow. However, we do not see any signs of an imminent recession. These two charts just show that the labour market is still very solid. We got very strong numbers out in July, and the labour market continues to be very sound. The consumer is in very good shape. If you look at a variety of metrics, they all point to very sound, very solid fundamentals at the consumer level. In fact, we don't anticipate that the next downturn is likely to be driven by the consumer because they simply haven't built up the level of excesses that had been the case leading up to prior recessions. And lastly, the Fed is unlikely to kill the current expansion. There's a very common occurrence or a reason why recessions occur or expansions end is that the Fed just raises rates too fast, too soon, and really curtails that growth too aggressively. It's not the problem this time around. Unlike previous rate hiking cycles, inflation right now is relatively contained, as we spoke to earlier. We don't anticipate inflation being a cause of consternation for the Fed moving forward. And the Fed has communicated an end to its current rate hiking cycle with rate cuts to come. Lastly, real interest rates remain historically low despite the Fed previously raising rates somewhat. The reality is no one is holding off on investing because rates are too high right now. Speaking of interest rates, we think we're in a period of lower for longer interest rates moving forward. Again, inflation is not an issue. So central banks are not pursuing easier, central banks are pursuing easy monetary policies. They're cutting rates in the face of slowing growth. They are not trying to hike rates to contain inflationary pressures. There's also a very strong anchoring effect, with international rates very, very low, which may keep US rates lower for longer. If you look at this chart here, the interest rate differential between the US and international 10-year yields. For this relationship to normalize, one of two things has to happen. International rates have to move higher, which we view as very unlikely given the fact that so many international central banks are pursuing much easier monetary policies, cutting rates, pursuing quantitative easing. Or US rates have to move lower. The implication here is that we're likely to be in a low real return environment for core fixed income for the foreseeable future. And we believe well-diversified fixed income portfolios that have dedicated allocations to satellite fixed income may generate enhanced income and total return throughout the forthcoming period. So with this backdrop, what actions are we taking? Well, first and foremost, stay diversified. Do not let emotions dictate investment decisions. Rather, we believe following a disciplined long-term approach to portfolio construction and rebalancing will add value over time. We continue to favor a globally diversified allocation to equities. While global equities are trading in line with historic averages, international and emerging market equities are currently trading at discounts relative to US equities and may ultimately benefit from an eventual trade agreement with China. We do actively manage our fixed income portfolios and have recently made a strategic decision to reduce our allocation to floating rate loans in favor of high quality, high yield securities, given our outlook for Fed rate cuts moving forward. We believe the current economic environment remains supportive for credit, but that floating rate securities may be challenged as the Fed cuts rates. Ultimately, we believe our portfolios are well positioned for the forthcoming period, offering a globally diversified portfolio that may weather the potential for ongoing market volatility, a lower for longer interest rate environment, and the ever-changing geopolitical and economic landscape. Thank you very much for listening to this presentation. As always, if you have any questions, please don't hesitate to contact your client advisor.